I'm actually on YouTube. Hopefully nobody saw that yet. Welcome, YouTube friends. We are live here with the Tax.Pro show. We're about to get filming, so I'm glad that you're here and you're going to get an opportunity to give us a thumbs up, give us a like, leave a comment if you got any tax questions. We're going to get into some fun stuff today, so welcome, welcome. It always helps if I name the right media, social media.
Yes.
There's all the medias. It's a little media confusing sometimes. Awesome. All right. We just want to do the intro.
Yeah.
Okay.
Put your mic slightly to your right, so it's squared up on you.
My mic to my
Yeah.
right.
Yeah, just the mic itself, not the arm.
The mic to the right. It can't move like.
Okay, that's good. That's good. That's perfect.
There.
Yeah.
Okay. We don't want a crooked mic.
No, looks good. All right. No crooked mic.
We don't want a crooked microphone.
You know who Crooked Mike is?
Well, crooked Mike might be the guy that.
He's the one who
He's
told
going-
you not to file your tax
He's going.
return.
Yeah, that's right. He's going straight to jail. We got to set the mic straight.
That's right. Because Mike is in jail for being Crooked Mike.
Crooked Mike.
He told you not to file your taxes. Anyways, okay.
If you're watching Crooked Mike's channel, you should stop. You need to watch the Straight Mike's channel. Straight and narrow Mike.
There you go. Okay. Ready when you are.
Okay. Hey, welcome to the Tax.Pro show. I'm Josh, CEO of Knapp Business Solutions, an EA with over 20 years experience. I'm glad you're here. We are going to get into some fun things today. So I've got, as usual, I've got Jackson joining me here.
What's up, y'all?
We'll be doing a little bit of back and forth. Let's get into it.
Awesome. What do we want our exordium to be on this one? Oh yeah, let's just run with the number one killer of small business.
Did we ever get the stats around what the numbers look like for failure,
Yes,
business
we did.
failures?
We did. They were less than I thought. Let me grab them.
Well, here's what can we pull just the stats around this?
Yes, whatever you need. %, of small businesses fall within the first year. Nearly 50% by the 5th year.
Payroll tax issues are the leading cause of small business financial distress. Roughly 40% of small businesses are fined an average of $850+ annually for payroll tax errors or late payments. IRS assesses over $8.5 billion in payroll penalties annually.
Wow.
This is interesting.
88% of small businesses find tax laws too complex to manage alone, increasing the risk of errors that lead to failure. Payroll errors account for over 30% of compliance issues flagged during audits.
Those are some compelling stats. Wow.
Common mistakes. More than 40% of small businesses are fined for late or improper payroll tax payments. Okay. Did you know that payroll taxes are the leading cause of distress for small businesses? We're going to get into the secrets and the things that you need to know today.
Hey, do that again, but don't give it away what you're talking about.
Okay,
Don't say payroll taxes
got it.
or payroll.
This one thing is the leading cause of small business distress. You're going to find out. We're going to find.
Crooked Mike will find you.
We're going to find more about it soon. This one issue causes erectile dysfunction.
Oh my God.
This one issue is the leading cause of distress in small businesses. We're going to get into it today.
Erectile dysfunction.
This one issue is the leading cause of erectile dysfunction. We're going to get into it today.
I love it. I love it. All right, do you want to introduce those stats, Jackson, or something like that, or what do you? How you
Yeah,
wanna
that'd
do
be good. I mean, do
Yeah,
you,
do you want to send them to me or?
yeah, I'll just send them to you.
Okay.
I like Jackson being like, yeah, this is an important issue, kind of set the basis of the problem, right? Here's the problem, and read those stats.
What the heck?
You slacking them to me? Or?
This did not, you ever have a copy fail? This is a copy fail. This did not copy well. How weird. Here, let me do it this way. No. It's gonna be weird.
You're good.
I could Google whatever.
I mean, I have some stats, but they're not the same as what. I mean, they're a little different.
They're not the ones I just shared.
They're not the ones you just shared, so.
These are powerful. Powerful. Have you ever heard of I got the power? I got the power.
Okay,
Powerful.
let's see.
This is not the singing show. We're getting our stuff ready here, YouTube. Thanks for jumping in. I appreciate y'all watching. We are working on filming this episode. It's gonna be good.
Okay.
Got it?
Yeah, I've got some.
Okay.
Some interesting stuff. Okay. While there's no singular exact percentage of total business failures attributed solely to payroll tax issues are leading causes of small business financial distress. And I've just done some researching this. The IRS assessed over $8.5 billion in civil penalties annually due to employment tax issues. And some of this can be caused to payroll tax. Elaborate more on this, Josh.
So the civil penalties, this is actually very important, okay? Because there's a big difference between just owing income tax and owing payroll tax. And most people don't understand that. When it comes to owing your income tax, that's your money that's being taxed, that you're paying tax on, that you owe to the government. With payroll taxes, it's not your money that you owe to the government, it's money that you withheld for others that you didn't pay to the government. So there's a big difference between those two and how the government assesses penalties on them. So one of the biggest penalties that can be assessed is known as the trust fund penalty. When the trust fund penalty is assessed, it's 100% penalty that's assessed to you, and it's not bankruptable. So let's say you file your taxes and you owe $100,000 of taxable. You had over 100,000. Let me start again. Let's say that you file your taxes and you owe $20,000 to the government that you haven't paid. After a period of time, if you don't pay that money, you can bankrupt it. With payroll tax penalties, there is no set amount of time. You owe the tax indefinitely, and they'll assess, garnishment on wages, and they will put a lien on your house, and it's very serious. So much so that they will assess 100% penalty from the entity's payroll taxes. Let's say you owe $100,000 in your entity for payroll taxes. They'll put 100% of that assessment on you as an individual.
Wow.
Until you pay that tax. So yeah, civil is very serious. It is not bankruptable. It's because it's other people's money. It's not your money.
I'm going to give this to you, Jackson. So have him back up a little bit and just explain a little bit more basic. What are payroll taxes? Like, for example, they come out of the employee paycheck or the employer. Who's responsible? What is FICA? What is it fund? What's the difference between Social Security and Medicare? Just the basic stuff.
Okay. Yeah, this is great. Okay, so let's back up a little bit. So you're saying that payroll tax is for employees, correct?
Right. So if you hire an employee, and with that employee, you're required to withhold payroll taxes from their pay. So if you're paying them a set hourly wage, you're required to withhold Social Security tax and federal income tax withholding based on their W-4 that they filled out and they gave you as an employer. You withhold those and you have to remit those at a set schedule with the government. And if you don't, that's when you get assessed big penalties.
Okay, so then what do the payroll taxes all include?
So there's two different things. There's actually more than two, but two main things, two main buckets of taxes that are withheld from payroll. There's your federal income tax bucket. That's one bucket. And that's what you go and you might get a refund on when you file your taxes as an individual at the end of the year. And there's another bucket that's Social Security tax. And that's going to be Medicare and Social Security, those two combined, and that's known as FICA tax. So there's actually two different people that pay into that bucket. One of them is the employee, and the other is the employer. So the employer is required to pay a match of the employee's Social Security tax. Those numbers combined are FICA tax. And that rate is basically 15.3% divided by 2. One half's the employer's responsibility, and one half's the employee responsibility.
So as far as self-employed businesses, what exactly does payroll tax look like for them?
It's a great question. So with self-employed, you have SE tax or Social Security tax, or that's really what it is. And it's the same thing. It's the 15.3% paid on your personal return, and you'll have to do a Schedule SE that reports your Social Security tax, and that portion goes to Social Security, and then you also have your income tax. So if you completed a Schedule C, the net profit, let's say it's $10,000, you're gonna have $10,000 subject to that first bucket, which is income tax, and then you're gonna also have $10,000 subject to that SE bucket, which is 15.3%. So those two make up your taxable income. So that's why for self-employment people, it's more expensive when they file their taxes versus an employee.
So I pay an employee $50,000, right? What is the true cost of an employer?
Of an employee to the employer?
Of an employee, yeah, for the employer, I'm sorry, excuse me.
Yeah, you're good. So if you pay an employee, there's a couple of different ways you can do this, but you want to calculate some things that go into the percentage of what it's going to cost the business. So if you're paying somebody $50,000, a good rule of thumb is to take the $50,000 times 20%, and that's going to cover most of the cost to the employer of that employee. Doesn't always cover all of it, but it'll cover the majority of it. And it might be a little bit too heavy, kind of depending on what benefits you offer. But there's other costs to the employer. So not only do you have the one half of the FICA tax, right? You've got that portion you've got to pay out of your pocket above the wages. You also have things like workers' comp insurance. You might have benefits like dental or health. You also may have things like 401k. Oh, and don't forget about PTO, paid time off, and holidays. So definitely there's more cost to the employer than you're just thinking when you just agree to pay somebody $50,000 to work for you.
So what kind of forms do you need to, what kind of forms are required? Let me start that over. What forms are required for payroll tax reporting?
Yeah, so most of your payroll taxes are reconciled on a quarterly basis. So you have the 941, which is you're going to file, and that's where you're going to reconcile those taxes that were withheld. And then you're going to also have a 940, which would also be filed quarterly. So you're going to file those 4 times a year. And then you also may have withholdings for the state. So states are going to have potentially, depending on the state law, you might have unemployment that has to be reported to the state. You might have state withholding off of an employee, their employee wages that has to be remitted to the state. And a lot of times those are quarterly as well. There can be a few circumstances where you only file and report and reconcile that annually, but for the most part, most small, large, medium-sized businesses, they have to reconcile their payroll numbers every quarter for the government or to the government.
Okay, I want to open up a new segment here. We've got a challenge Well, Challenger, brought to you by Blue Horizon Insurance. They're going to bring in a challenge for you. And here's the challenge. Okay, at the opener of today's episode, you told us that payroll taxes are a huge issue for small businesses. I'm skeptical, okay? Because it seems to me that there's going to be other expenses that are going to be driving these small businesses down, such as debt, probably maybe even travel, right? You're going to go to seminars, you've got airplane costs. How is this so, Josh? Because I do not see it.
Yeah, so
I mean, seriously, come on.
here's the thing. If you don't pay your payroll taxes, you won't be in business for long. It's one of the number one things that IRS goes after, attacks, to ensure that they're collecting the most amount of revenue from those employers. The abuse is huge in this area. It's so big, in fact, that this is where the guys with guns from the IRS, they really come into play. Because they'll come to your business and shut you down if you're not in compliance. They will seize your assets. They will take everything that you have from you for failure to pay payroll taxes. And it doesn't go away. You can't get rid of this with bankruptcy. You can't get rid of this just with anything other than paying the taxes.
I mean, you've been doing this for years. Have you really seen this been done before?
Yes, I have absolutely seen this been done before. Business owners get put out of business for not paying their payroll taxes. This is not something you can put off. This is not something that you can just willy-nilly and screw around with. You got to be very serious. Actually, I'll even take it a step further. When you're looking for a payroll company that's going to partner with you as a small business and help you with your payroll, you want to ensure that your payroll taxes are being deducted from your bank account, not by that payroll provider, but actually you want to make sure that those payroll taxes are going to the government themselves. Because there's many cases, and this happens all the time, where a payroll provider will come in and they will impound, they will pull your taxes, and then they don't give them to the government. They take the money and they run. And you're still on the hook for those payroll taxes because you collected them, even if you didn't pay them. If you don't pay the payroll taxes of what you collected, that's somebody else's money that you're holding. And if you give it to the wrong person, the government doesn't care. They're still going to go after you. They're still going to nail you for it. They're still going to assess 100% penalty to ensure that you pay those taxes to the government. They're trust fund taxes.
Should I just go to the next question?
Yeah.
Okay. I don't know if I should end that or anything.
Fantastic job. That was great.
Okay.
So this next question, why does the IRS treat payroll taxes?
Is that the next one you would like me to go into? Okay.
And you could preface it by saying, wow, so you're saying guys with guns, like,
Okay.
you know,
Yeah.
why does the IRS treat it more seriously than other taxes?
Wow. So this is clearly a serious issue. You're saying guys with guns come up to the small business owners, right? Seriously don't want to be in this kind of situation. Why does the IRS treat payroll taxes more seriously than other taxes?
Yeah, the number one reason is not the taxpayers' money. Only a portion of it comes from the small business. The majority of this is withheld from employees. So you're not stealing from the government. You're stealing from other individuals when you don't pay your payroll taxes. That's why.
I've never really thought about it like that. That's interesting. So why do some small business... Okay. So why do some businesses try to classify employees or just workers in general as contractors?
This is a great question. So the difference between W-2 and a contractor is very important. And I see this, we see this all the freaking time. People screw this up. So let's talk about it. There's generally 3 tests that every small business owner can run through. And this is not from the IRS, this is not from the state, but there's 3 things. And if you have an employee that fail, it pretty much encompasses the pages of things that IRS would look at, okay? 3 simple things. Number 1, who sets their schedule? Do they set their schedule or do you set their schedule? Are they at the office from 9 to 5? Or can they come and go as they please? That's test number 1. If they are at the office from 9 to 5, they are an employee. If they don't set their schedule, they're an employee. If they have freedom, then they fall more towards the contractor side. Number two, who else do they work for? Do they do this exact same job for only you, or do they do this exact job for lots of other clients? If they only work for you, that's more of an employee. If they have 10 other clients that they do the exact same thing for, or 100 or 1,000, then they're much more likely a contractor. They're in business for themselves. Number three is who supplies the equipment. Do they bring their own equipment with them, or do you supply their equipment and tools? If they're coming in and you're supplying 100% of what they need to do their job, much more like an employee. But if they bring everything with them, they're more like a contractor. Now I'm going to give you a practical example of what that looks like. I have a personal assistant. She comes in, she has set hours, or he. Not only do they have set hours, they don't do this work for anybody else. They only do the work for me. And not only is that all true, I supply the equipment. So I'm giving them the computer, I'm giving them desk space, I'm giving them the desk. All of it is my control, my equipment. I dictate their schedule. That's clearly an employee. Now, let's say that this personal assistant, he or she, also has a painting side business. And they come in and I hire them to paint my bathroom at work. And they come and they paint that bathroom. Are they an employee or are they a contractor? Let's run through the three things I just gave you. So as a painter, they come in. I don't set a schedule. They can come in and do that job whenever they're available to do it, to complete it. Number two, they do this job for many other people. They have lots of other customers that they paint for. And then number three, they bring in their own equipment, their own paintbrushes, their own drop cloths. They bring in their own material and supplies. That is a contractor. Those are the basic differences between an employee and a contractor. The reason small businesses want to pay their people as a contractor is because they don't want to be on the hook for the 7% of FICA tax that they're supposed to pay on behalf of that employee. It saves them money. But the IRS doesn't care. More than that, the Department of Labor definitely doesn't care. They're going to go back to those set standards, and whichever bucket or category you fall into, that's how you're going to be treated. And then if you don't do it right, they're going to assess that tax on you and on your small business. So it's very important you've got somebody in your corner, you understand these rules, and you're able to move forward.
So, in a sense, I see that reporting an employee or, oh my gosh, I see that in a sense reporting a worker as a subcontractor seems to be at a lower cost as far as for the employer's benefit or the one who has hired the subcontractor's work. Is this true, or is it probably more cost efficient as far as hiring an employee or W-2 worker?
Try again with less words.
And don't say subcontractor.
Just say, why would business owners do business owners save money when they pay contractors versus employees?
Yeah.
Do business owners save money choosing to pay subcontractors rather than employees?
Yes, that's why they want to do it. And it's not just the money savings, it's, I think, more of the hassle factor. They save a little bit of money, not that much money, right? 7% on the total wages is not that much money. What they really save, though, is a big hassle factor. Because with employees, you have to track time, you have to track, a lot more resources, there's a lot more accountability involved. Plus, if you fire them without cause, they can go file for unemployment. So you've got to make sure you're in compliance on a lot more fronts.
I've lost my questions. Sorry, Brittany, you're going to hate me on this episode because you're editing a lot. So when should a business owner start payroll?
That is a great question. The moment they hire an employee. If they hire an employee, based on those definitions that I just gave you, if they hire an employee, then I would recommend they start payroll right then. They need a few things in order to start payroll. First, if you're new to this, I would strongly recommend you don't do it on your own. There's a lot of complexities and a lot of compliance, state-specific things that we're definitely not getting into, as well as the federal government. Get somebody in your corner that has the heart of a teacher that's going to teach you the right things to do with payroll. So that's thing number one. Thing number two, I don't remember what the question was.
It was, when should a business owner start payroll? I mean, the next one is also, what's the easiest way for a small business to handle payroll?
Yeah, so the best and the easiest way is to hire somebody else to help you make sure you're in compliance. And that's what I would tell you. I would say hire somebody that knows what the flip they're doing if you're new to this, and they'll get you the right pieces in place to make sure that you're successful. You know, even understanding the very basics of even understanding the schedule of when you have to pay those taxes, when they're due, how to pay them. There's a lot of nuances with payroll. It's one of the most complex areas, and there's gross non-compliance in this area, and the IRS knows it.
Shout out to Payorty, right?
That's right. Shout out to Payorty. If you don't know, hire those guys.
Yes, they know what they're doing. So, what is the one?
What is the one?
Screwing this up.
What is the
Okay. What is one payroll habit that every business should start implementing tomorrow or yesterday?
So there's a few things to this. It's hard for me to narrow it down to one, but I would say if I narrowed it down to one specific thing, it would be that you're very aware of the amount of tax that you need to be setting aside in your business so that you've got the money to pay those payroll taxes. And you don't spend this money. I mean, if you don't eat a meal that week, then you don't eat a meal that week. You don't use this money to go buy food. You just fast. I mean, seriously, it's that important. I can't stress it enough. I'm not saying to fast or to starve yourself to death, but I am saying the payroll tax money is not your money. So don't spend it.
Good stuff. Let's do an incentive question. So I would almost love, Jackson, if you do it.
Sure.
But
what's the?
You could say, hey, if you have any questions about payroll taxes, W-2 employees, contract employees, any of that, leave us a comment below.
Hey, if you've got any questions about payroll taxes, payroll, getting started on payroll, let us know in the comments below. We would love to reach out. Thank you so much. Should I start over on that one?
I thought it was okay.
Okay.
You want to try it again?
I don't know. What do you think?
It doesn't sound like you're talking naturally, like
Yeah.
really ask the question. Try it again.
Hey, thank you so much for joining us. If you've got a comment, oh my gosh. Thank you so much for joining us. If you have a question about payroll taxes or need help starting your payroll with your business, comment below, and we would love to reach out with you.
Reach out to you.
So
Reach out to you.
How about
Get in touch with you.
say this?
If you've got if you have a payroll or payroll tax question, or
Why don't you just say
comment
this?
below, and
What?
we would love to.
Why don't you say this?
we would
If
love-
you've had a challenge with payroll, comment below.
Yes. If you've had a challenge with payroll, please comment below. Thank you so much.
If you are as challenged as I am on camera,
If you,
no, I'm just
if
kidding.
you, if you screw up as many times as I do.
No, you're doing great. I'm just kidding. That's awesome.
Cut my mic.
All right. Anything else you think of, Josh?
Need that staff to like.
Oh, we covered a lot. I don't know. It's a long episode.
We're 30 minutes in
So-
with all the nonsense.
Really?
So I think we'll cut it down to like 18 or yeah.
It's fine. Yeah, it's payroll tax is a lot, man. I mean,
I told her a second ago, I was like whispering, I was like, WT versus contract's a whole episode.
it really is.
We
Well,
might
and we'll
break
do it
that out.
again. Yeah.
We might break that into like its own short, like
Yeah.
we could do like a 2-minute short or something. But anyway,
Okay.
close this out with a close and then outro.
All right. So we've been through all these different things with payroll taxes. Hopefully, we have clarified some of the things that were confusing. So glad that you stopped by for this episode. When you get a chance, like right now, not like right now, go ahead and just hit the like button and the subscribe button to this channel. We really want to further the message of our mission of helping people understand taxation in America. And we're glad to be a part of your journey on that. So if you gained something from this episode, like, subscribe, share, talk to your friends, help us out. Have a good one.
If you want to add a percentage of body fat to bears that are in winter hibernation, subscribe to this channel.
Please.
Okay, the next episode, moving right along,
Okay?
we are going to talk capital gains. Let's get them gains. So,
Or losses, kind of, right?
yeah, you could. $30,000 minimum loss, right?
The bases.
maximum loss.
What is
The bases. Not
The
bases like baseball.
That's how much,
What's
like,
the basis?
The bases.
that's how much, that's your,
That's-
well, if you have more than that, you get carryover too, right?
Yeah, it just carries over indefinitely.
Yeah.
Capital
Oh,
losses.
like even if you just have 3,000?
If you have if you have 3,000, you can take it. But if you got 300,000, then it carries over.
Something like,
Hmm
I don't know why people wouldn't do that. I have losses of 3,000 and it just carries over every year.
Okay, so for
Never mind, but like, if they were just trying to get 3,000 just so they carry it over every year. They have to
Oh,
be
yeah,
higher.
no, I mean,
Oh, like that
you would just take it on that 1 year and it wouldn't carry over.
Yeah. No.
Carryover is when you have more than 3,000.
Right, that's right.
Josh, what would you say is like the most wow factor about capital gains, or maybe most common thing that you get asked about? Maybe is another way to ask. I'm looking for an
I think
example.
one of the things would be a lot of people don't realize that they're taxed at different brackets than ordinary. Long-term capital gains are at different brackets than ordinary income.
Yeah.
And so we can do a lot of things, and we can, like right now, we actually, the lowest capital gain rate's 0%,
Sweet.
and we can capitalize on that with tax planning if
Ooh, okay,
we're
let's do
aware,
that.
right?
That's our exordium.
Oh, that's great.
So
yeah.
say, did you know you can, with this one thing, you can get,
Pay zero tax.
Yes, love it.
Did you know with this one secret, you have the ability to pay zero taxes?
Join the Illuminati.
That's actually really great exordium.
That is really good.
Join the Illuminati. That's not it.
Thank you.
That's-
Jackson.
Well, no, but I mean like the zero.
Yeah, that's awesome. That's good. Secrets of the wealthy, right?
Secrets of the wealthy. Actually, the wealthy don't qualify, but
Yeah, exactly.
it's all good.
Okay, so give us an intro, Josh, and then introduce Jackson.
Okay. Okay. Let's see here.
So any questions, Jackson?
Hey, welcome to the Tax.Pro Show. I'm Josh, an EA with over 20 years experience. I am glad you've joined us. We're going to get into a fun topic here, chatting a little bit about capital gains. So with me today is Jackson, and we're going to talk.
Howdy, y'all.
We're going to talk capital gains.
And the rapture happened.
Go ahead, Jackson.
All right, you ready, Jackson?
Yeah. Did you message me? Oh, you did. Okay.
Are y'all not ready? Do we need a minute? I can go get a cup of coffee.
No, we're good. We are rolling.
Get them gains.
What exactly is a capital gain, and why does the IRS treat it differently than ordinary income?
Well, a capital gain is a gain on a capital asset. And so what is a capital asset? A capital asset is generally something that you're investing in that is not active income that creates more capital for you. And so a capital gain would be the tax on the gain of that capital asset. So that's a lot of just really technical talk and boring.
Yeah, give me an example.
So let's say that I'll give you two examples. I'll give you two examples. So let's say that you buy some stock in the stock market and you sell that stock for a gain of $10. You paid $100, you sell it for $110, your gain's $10. Then you would have a capital gain of $10. It's kind of like another way of saying a return on your money. The other example I would give you is like a capital loss, but some capital losses are not deductible and some are deductible. It depends on that capital loss. So like if you buy a personal vehicle, like a car, and it's just your daily driver and you spend $30,000, and we all know cars go down in value, and you sell it for $20,000, you'd have a capital loss of $10,000. That particular capital loss is not deductible, so you wouldn't get to take that $10,000 loss.
I was not ready for that. So what's the difference between short-term and long-term capital gains?
Absolutely. The holding period is the difference between short-term and long-term capital gains and the rate at which they're taxed. So short-term capital gains are less than a year and they are taxed at your normal tax brackets. Long-term capital gains, these are the ones that we generally want. They have three different brackets. They have 0, 15, and 20% depending on your income. And those are the ones that you've held. Long-term capital gains are what you've held over a year. So if you've owned the asset for longer than a year, long-term capital gain. Under a year, short-term capital gain.
So can someone realistically pay 0% tax on capital gains?
Absolutely. So if you had the right income and you had something that you had long-term capital gains on, held it for more than a year, and you sold that asset, you can pay 0% tax on that capital gain. We actually see this all the time, and we take advantage of it regularly. This is generally not for super high income earners. This is for more of lower middle class, but absolutely you can.
So if you were to break it down, what are like 3 big misunderstandings people have about capital gains?
Hold on just a minute.
You're fine. I was not ready earlier, so.
I just want to look at the current brackets for 26. Okay, so that 0% rate is 49,450. Married is 98,900.
That's right. We just looked at that. 49.
Yeah. So that's for 2026. What was the question?
So if you were to break it down into like the top 3, yeah.
Break it down.
Yeah, break it down, right? What were the top 3 biggest misunderstandings people have on capital gains tax?
Top 3 biggest mistakes or misunderstanding.
Yeah.
Well, number one, I think a lot of people don't understand that there are 2 potentially different sets of brackets depending on long-term and short-term capital gain. So that's one thing that definitely confuses people with regard to capital gains. How that affects their taxes. The other thing is there's this NIIT tax, net investment income tax, that can apply to capital gains, which is another 3%. Thanks to Obamacare is what created that. And so that's basically an additional Medicare tax that goes on those capital gains. So depending on where you fall and the type of gain, you also might have that in addition to your brackets. So there's 2 of them. And I would say the other one, I think the other biggest misconception that people have, and this actually is bigger than those 2, that is people don't understand the importance of tracking their basis. And basis is what you paid and or what your investment in that item was. And your basis is dollar for dollar reduction of that capital gain. So of what is taxed or not taxed. So let me give you an example. Let's say you buy stock at $100 and then you buy stock, more of it at $200 and then another round of it at $300. Well, you need to track your basis for each of those purchases so that you know how much money you put into each of them. So when you go to sell them, you'll have different capital gains off of those purchases of those stocks. So the basis becomes very important to the taxpayer, and understand that basis is critical, and most people don't have a clue.
So tell me about taking up losses within capital gains.
So when it comes to capital gain losses, tax strategy gets a little bit tricky. I'm going to give you a couple practical things. The first thing to note is you can only take up to a $3,000 loss. It's limited. You get a $3,000 capital loss per year, and that carryover is indefinite. I've seen clients that had literally millions of dollars in capital losses carryover, and it is very unfortunate when that happens. So because they can only get $3,000 a year. So that's thing number one to keep in mind with losses. So you get to take $3,000 a year. The rest of it carries over until you utilize that $3,000 a year. So that's one thing that's bad about capital losses. When it comes to tax strategy, though, if we know we're going to have a capital loss, we can offset a good capital gain as long as they occurred, in that same year, or if we have loss carryover, we can then offset that gain. And so there does become a little bit of tax strategy around that. If you've got some capital losses, You need to get with your tax pro to see if you can maximize when it is you want to take those losses against other gains.
Okay, I've got a challenge brought to you by Blue Horizon Insurance. Here's the deal, hotshot accountant. Okay, I've got a little bit of a scenario for you. Okay, I bought 15 years ago, I bought $100,000. Today, it's of capital gains, right? Today, it's worth $1.2 million. I'm considering three options: sell the stock now, donate the stock to charity, or hold the stock until death and pass it to my kids. Assuming that I am in a 20% long-term capital gains bracket and I'm subject to the net investment income tax, 3.8%, and I also live in a state where there's no income tax, how can you help me reduce my tax bill? Because I don't see it. That's problematic. Looks like you're buying us time.
Did we pause?
I don't know.
Probably knocked off the live stream a bit, huh?
You're buying
It's
us
still counting.
time.
Sorry, live stream. We got a phone call. All right.
You can't actually answer the question, can you?
I got to check one thing.
Yeah, that's what they all say.
I'm pretty sure I'm right, but I should just answer it and then check it later. Yeah. Okay, we have some options. So in that scenario, we might do one of them or we might do some of all of them. You don't necessarily have to decide today. It doesn't sound like there's an impending issue that you've got to decide right now what you're going to do with that stock. If you're in a community property state and you're married, you could hold the stock until one of you passes. And at that point, you get 100% step up in basis and you sell it and you don't pay any tax. That is an option. Another thing, so holding it, I definitely like that plan if you don't need the money. Another thing would be donating it to charity. Yes, you absolutely can. When you donate to charity, you don't just get your basis, you also get to take the fair market value as a tax deduction under that charitable contribution. But that's only to your advantage if you've got taxable income. And in this scenario, we don't have enough information to know if they have taxable income. They would potentially have taxable income if they sold some of the stock, but assuming that they don't have taxable income, is charity the best option or not? Good question. And then what was the third one? Something about a kid?
Hold the stock until death and pass it to my kids.
So if you're single, you're not married, or you're in a non-community property state, then you could hold it. When you die, the stock steps up in basis. Your kids are not going to pay any tax on it. So any of those are fine. I think the question becomes, what is going to be the best for you holistically, not so much what's the best tax move with this scenario.
So if I were to donate the stock, whenever I sell it, then I have to pay tax on those gains? Like, how does that work?
You donate the stock directly to charity, and then they're nonprofit, so they don't pay tax on those gains. Nobody pays tax on those gains, but you get to deduct, as if you sold it and gave it to charity. You get to take the full deduction on Schedule A, assuming you have other income.
Okay. So out of those three options that we just talked about, what is the best result for paying the lowest tax? Do you know, or do we need more information on that?
I would need more information. It could be a few things. We might, depending on your income, what we might do is, and if you're married or not, we might sell some of it every year and take advantage of the 0%. If we did that and we kept you at that 0% bracket, then you could just turn around and give the money to your kids, and they wouldn't pay any tax and you wouldn't pay any tax. So like I said, we might do a combination. We might also give some to charity and sell some to create a situation where we would be able to take the charitable donation. There's a million options, and it's really more circumstantial to the individual.
You'd mentioned basis. Tell me about the step up in basis rule.
So with step up in basis, whatever you paid for the item, that is your basis. So let's say you paid $100 for some Apple stock, and let's say you held it for 50 years, and when you died, that same stock, the fair market value was $1,000 per share, and you paid $100 per share. Well, when you die, whoever inherits it gets a step up in basis of that stock. So their basis is the $1,000 per share, and nobody pays tax on the gain from the 100 to the 1,000, which would be $900 per share. That's what step up in basis is.
Okay. Well, you answered that challenge pretty well, I'll say. Good job to you. Okay, tell me about the wash sale rule.
So when it comes to wash sales, this is like when I'll give you an example because it's easier to understand this with an example. Let's say you buy Apple stock. I'm picking on Apple today. Let's switch.
Sure.
Let's say you buy Microsoft stock.
Yeah.
You buy Microsoft stock, and then you sell the Microsoft stock, and then you buy more Microsoft stock quickly after, like within, I think it's 30 days. Is it 30 days? It's 30. Anybody know?
Seems right.
I think it's 30 days.
30-day window.
Okay.
Yeah.
So if you buy the same Microsoft stock within 30 days, then you don't get to take the loss on that stock. And it becomes what's known as a wash sale, which means the loss just changes your basis on the repurchased amount.
Oh, I'm sorry, back up. It says it's a 61-day window, 30 days before the sale, the day of the sale, and 31 days after the sale. Or
Okay,
30
there you
days
go.
after the sale.
Yeah, I was like, that's right.
So it's 30 before, 30 after, and the day of, so 61.
61 days.
61.
Okay, so let's start that again. So, according to the 61-day rule, you've got 30 days before you purchase that stock, the day of, and 30 days after. You can't have sold the same stock in that time frame. If you do, wash sell rules apply. And this happened with harvesting is where this law came from. Guys would harvest the loss that year and then just turn right around and buy the stock back and reduce their taxes. And so that's why they created this rule. What happens is it just reduces your basis on the next purchase. So you don't get to take the loss, but your basis is adjusted accordingly. It reduces or increases your basis on the stock. I think actually it increases it, right? We have to edit this out a little bit.
I think, yeah.
I think it increases your basis because you didn't take the loss, so your basis is higher. The amount is increased.
Or you sell a security at a loss within 30 days, but on that same, the loss is added to the cost.
Yep, so it adds to your
Yeah.
basis. That's right. So, all right. So, if you don't sell it, if you buy other stock within that 61-day window, 30 days on one side, 30 days on the other side, an actual day, then what happens is the loss gets added to your basis of the next purchase. You don't get to claim the loss on your tax return for that year.
Thus, like a wash.
It's
Wash sale.
Right.
rule.
It's a wash because you don't get to take it. And the reason they created that was because people were harvesting losses to reduce their taxes. And they said no. Congress is like, no.
So what's the single, if you had to sum all this up, we've talked about a lot, and we could keep talking, because there's a lot on capital gains. What is the single biggest capital gains mistake you see clients make today?
I think it is that they don't optimize several different things within it. There's really not a lot of tax strategy. So I'll give you a couple of key things. If you know you're going to have a capital loss, we want to think about where we can offset that capital loss to avoid the $3,000 limit with a capital gain. So that's thing number one. The other thing that I think people don't do is they don't use their brackets in their strategy. They don't think about, well, I can get this out, I can sell this stock and pay zero tax on it today. And so they don't do that. And by not taking advantage of that, the rates change. We've had the same rates for several years now, but there's been times that we had, 20% or higher capital gain rate flat across the board. So they're not taking advantage of the planning around using those lower capital gain brackets. And I would say those are probably the two biggest things that people don't do in tax strategy.
Is there capital gains rates for state tax? I don't know. I just wanted to ask this. Like, is that a thing?
Yeah, so some states tax capital gains. Every state's a little bit different as far as the rate of the capital gain and how they tax it. Some states don't tax them. It just kind of depends. And then some states, you don't have to file income tax for your earned income, only on your capital gains do you file, or your passive income. So it just kind of depends on the state and the state law.
Did we cover the different rates? I can't remember.
Yeah.
We did, okay.
We did, yeah,
0, 15, 20.
Okay, good, just making sure.
And then you've got the extra 38 on, if you're,
Yeah.
yeah,
Okay,
the net tax.
Well, they're 3.8, yeah, 4% basically.
no more question.
Yeah.
I sent it to you.
Oh, shoot, oh, yeah. This is a good question, actually. If someone is sitting on huge gains right now and they're about to sell, or they're thinking about it, what should they do before selling?
Definitely talk to a tax pro. Do not assume that you know what to do. Do not assume that you understand the law. This is a complicated topic. There's a lot to it. There's a lot of moving pieces. There's a lot of things that could change the scenario. And so if you're thinking about whole life focus and you're trying to figure out the best way to navigate it, this is when you should get some good tax planning, get with your tax pro, and learn more about your situation and what you need to do.
Very good. Let's do the interactive. Hey, do you have questions about capital gains? They must comment below.
Do you have capital gains questions?
You can say it that way.
Yeah,
You have
okay.
some massive gains.
Do you have
some massive gains?
That's what she said.
Yeah. Do you have some massive capital gains tax questions? Please comment below.
Hold on, you said massive tax. Capital gains questions. That was awesome. I mean, I like it, but.
Okay.
Do you have some massive capital gains questions?
Big ones. We only want the really paragraphs.
All caps.
Just put a PDF in there. Do you have some?
Do you have capital gains questions?
Yeah. Do you have capital gains questions? Please comment below.
Sweet, good. All right, outro. Josh, you got us.
Hey, thanks so much for taking the time to watch this episode. I'm so glad that you've joined us today. Listen, if you've got some capital gains things going on, we are happy to help. At Tax.pro, you can reach out. One of our team members is going to help you and get those things squared away and help you have some tax strategy. Thanks so much for stopping by. Don't forget to like and subscribe. Listen, when you do that, it helps us further the message of this channel and further people learning more about taxation. Thanks again. We'll see you on the next one.
Beautiful. And then for our pictures, what do you think about taking some pictures of Jackson where Josh is at? And like using him for thumbnails? Would that work?
Are we good? You going to end live?
Yes, sir.
Thanks, everybody. We'll see you on the next one.
See
Appreciate
ya.
ya.